Let's talk about a company that's neither, then, in that case. Let's get back to the dodgy accounting, shall we? And this time we definitely can say it's dodgy accounting. WHSmith. Today is Thursday. They issued a profit warning yesterday, which was Wednesday. And as a result, the stock went up 7%. That's not normal. But lots of things are not normal right now with WHSmith. They announced that their US trading profits for this year are going to be somewhere between 5 million and 15 million. That's down from the 25 million they were expecting after they announced their accounting irregularities in that part of their business, and way down from the 55 million that they were expecting before they had discovered these issues around revenue recognition and, income recognition, basically. However, so concludes pretty much the issues to do with the audit after their discovered accounting irregularities. The CEO has now gone. Which I think is the right move. I think probably more than the CEO ought to be making their way out here. And one thing it does highlight in all of this is the risks that, or at least that I'm reminded of, is the risks that come with a decentralized structure. We talk a lot about the strength of these in various conglomerates of decentralized nature means you can make decisions closer to customers, you can be more receptive, you encourage an entrepreneurial spirit in parts of your business. All of those things are true. The downside is if you have lots of independently operating bits, there's a chance somebody might be screwing something up and you can't see it very well. And that is what's been happening with WHSmith. And I'm not saying that happens in any other companies at the moment, but a decentralized structure, which I generally tend to like, makes this more likely than if you've got someone overseeing everything. Basically, it's slower, but less likely to, or less scope for something to individually go wrong because someone makes a mess of it. Anyway, so concludes the audit from Deloitte, and there are a couple of reasons I guess this stock might be going higher. One of them, which I generally don't subscribe to very much, but I might do here, is that a lot of uncertainty goes out the window. I've been sat on this stock for the last, however long it's been, thinking about it and trying to write about it and thinking I can't even tell you anything sensible about this company right now because I can't tell you anything about its numbers. We talk a lot about earnings reports and so on and we will do again later on this show, and we can say, well, I think this number was good or bad, or this number's more important than that number or whatever. But if we're not talking about the right numbers, it's all basically irrelevant. It doesn't matter whether we think that revenue number is better or worse than it should have been if it's not the actual revenue number. And it doesn't matter whether we think trading profits are very important if we think that's not the trading profit number. So it at least gets investors back, we can say at this point, to some degree of confidence if they can think about the stock in a meaningful way, and they can decide it's expensive, they can decide it's cheap, they can decide they don't know, they can decide it's about right. I'm in the camp that says probably about right here, to be honest, and that's not great because I'm down quite a lot on it, but I now think it's selling at about the right price for the time being anyway. We will see how things develop, but there is at least now a chance for investors to have a meaningful and sensible discussion about this thing based on some numbers that are actually accurate, or we have very good reason to think are accurate at this point. The other thing is that the audit report said, and I quote, the issue around income was, quote, substantially a timing rather than an existence issue, i.e. it's to do with when these things are being recognised rather than that they're being made up all over the place. And so essentially what's happening is these are being reassigned to various time periods in which they're actually earned rather than the kind of time the deals are agreed. And so that means some of it goes back into the past, some of it goes forward into the future. Some of it does disappear, things that haven't been earned and are not going to be earned. So there is of that kind of total lost revenue thing, quite a bit that goes in the category of won't be earned. They've kind of broke it down into a 32 million gross loss, which is 12 million lost and 20 million kind of recognized in the future. 13 million to be recognized backwards, basically, as already having been earned. And on top of that, there's a 20 million inventory hit. So there's a lot going on that will involve restating some of the 2024 accounts and so on and so forth. When all of this washes out, they're looking at, from the whole thing, trading profits for the year. The year actually ended in August, but they're getting around to trying to figure out what the numbers actually are. And I can see why that's taking longer than it might otherwise have. The report was due, I think, on the 12th of November. It's now due in December. They're expecting to say something between 100 million and 110 million. And if you look at their market cap, which is 800 and something, and their debt, which is 300 and something, you get to a multiple of around 11 on that. And a multiple of around 11 is probably about right for a retailer. Growth is now basically impossible to gauge for the time being because it requires a lot of back restating of things. But it's an interesting retailer. It's in good locations. We've talked before about how if you operate out of train stations and airports and hospitals, you're not just getting hammered by e-commerce the way they were before. I still think their decision to sell their high street arm was a good one. Disappointed they didn't manage to get more for it. Is this worth a go at an EV multiple of 11? I think intrinsically there's not much wrong with that price, but I think at the moment, with where the stock market is, there are plenty of better things to be looking at buying right now, and which is why I don't often say hold, but if I was sticking a rating on this, I probably would go with hold, and that's pretty much what I'm planning on doing. Be interested to see what happens to their dividend, because I'd like to see them get rid of it and turn it all onto buybacks, because their stock is now 55% lower than it was 5 years ago, and 5 years ago, most of their bloody shops weren't even open. Steve, what do you make of any of this?
It's been a disaster, I think, is what it's been. The CFO, who had been there for a fair while, it looks like nearly a couple of decades, was obviously the first to get the chopping block. Greg's took one look at that and saw this is the man who needs to become the chair of our audit committee, and hired him. So I was going to call it his new role, and then I was going to make a joke about sausage roll, but I couldn't quite get it in there for you, Steve. But he has since been told he cannot have that role at Greg's, and has had to withdraw, because there can't be anything worse than the damning report that's just come out about the performance culture and the way that the numbers are being recorded. You cannot take a role up as heading an audit chair at another company. That just doesn't make any sense. But I think the same as you, Steve. We've said it before. The actual underlying business of this new WHSmith. This is not the high street retail WHSmith anymore. That doesn't exist. That's TG Jones or something like that. This is the captive audience business that's in your airports and your train stations and your like truck stops and things like that, across Europe and across America under different brands. This is a decent business if they can get a handle on the numbers and they can keep that net debt coming down, and if they can start buybacks going, Steve, this is a very attractive business. I think one of the issues investors have at the moment is that when they think about WHSmith, they think about that store that's been on your high street for a very long time that nobody is ever inside of. And that's not the business anymore. This is the place where you go when you have nowhere else to go and end up spending £11.95 on a sandwich with one piece of ham in it. That's the business here, and it should do very well. And there's no reason that I can see, Steve, that it should continue to fail from here. I think it'd be interesting to see the restated numbers when they come out. It looks like they're going to have to restate 2023 and 2024. 2025 is going to be a very poor year for them, but there's still 1,300 stores across the world, train stations, hospitals, airports, and I think it'd be pretty interesting going forward, Steve. I think this might be the point where you should not really do anything and see what happens moving forward. But I think if the report comes out and the profits are up in these previous years, I'm not sure about that. But if that happens, this stock might do a lot better going forward because people will have a clearer vision of what this business looks like when it's not making a mess of its figures. So yes, I think when we get the finalised numbers through, Steve, I think it'll be a lot more interesting. I think you might see that this underlying business is very good, the bit that they've hung on to. But I don't think it's something I would be in a rush to buy. I'm certainly not in a rush to buy it, but I'm not dead against it. Which when the other business was on the side of it, I was probably, I was a little bit less interested in it. The price they got for that is the price it was worth. But we'll see moving forward. Steve, I'm not that against it. Is this on your list of things to buy?
Probably not. I think it's an interesting business for someone to come into as a CEO, for the right CEO to come into. There's something there worth working with. They're currently probably fairly bombed out in terms of a stock and a business and a reputation. So there's work to do, but things could improve from where they are at the moment. Kind of a pity Dave Lewis is busy at the moment. He seems like the kind of guy you want for this, coming in from having turned around Tesco, admittedly from a low base, but actually genuinely getting them to quite a good competitive position that isn't just kind of making obvious and easy changes here. Someone like that to run WHSmith would be interesting, I sort of think here. It's a tough one in that it feels like the real kind of importance here. We never really talk much about the risk of investing, but your kind of base or worst case for investing is always that you discover something is wrong with the accounting. We might have said this before, and it's just not a thing that we're in a position to know from here. I'm not really sure any investors are in a position to know that particularly. There was quite a big short interest in WHSmith before all of this kind of actually came to light, but that was mostly to do with the state of its balance sheet, which was reasonably heavily levered. They're talking about being kind of twice levered at the moment, which is not great, not terrible. I think it'd be nice to see that number come down. Although in the short term, I think while their share price is down where it is, I'd like to see them try and bring it down, because I don't really want a dividend out of this company for the time being while they figure this out. We can get back to that in the future if it gets paid. And they haven't said it's not, but wouldn't be massively surprised to see it gets cut in December. Haven't looked into the affordability on it yet. It would be a good thing for me, I think, if they didn't and used it to... they've got better uses for that capital at the moment. There's a promising looking growth story through the US that doesn't just go through revenue accounting and is kind of entirely independent of that. They think they've got quite a runway to go opening new stores. And opening new stores isn't always the be-all and end-all of these things, but it can drive things along. It can't drive things along forever, in that you can't open new stores indefinitely, but they do have quite a bit of a way to go on that. And their US business, well, it was looking promising. It now becomes difficult to know exactly, but hopefully with a few restated things, you'll be able to get a better sign of whether things are moving in the right direction. Because if you take this year's numbers, they're moving absolutely the wrong one, but that's not really the kind of thing to look at. You have to try and redo the last couple of years as well, and that will give us a much clearer sense of what's going on. So I'm probably marking my calendar for when this one comes around now December. That was pushed back, and I think I messaged you at the time saying WHSmith have pushed back their earnings while their report's going on. That's always a good sign to see that kind of thing happening. We always want people to say, well, hang on, we're probably not in a position to tell you just yet. But it's interesting with these kind of situations in general. We've seen Vistry not really recover from its accounting issues, despite the fact that actually most of so Vistry said it was going to weigh on operating income through this year, next year, and the year after, but going down quite a bit in each year with the impact of these things. And so we should be seeing things naturally start to pick up there a little bit. Stock hasn't really snapped back in any meaningful way. So WHSmith, I'd wary about kind of anyone who thinks about it here jumping on a falling knife. I mean, it was up a bit yesterday, but it's only up a little bit on the week, so you might have to be ready to sit on this one. But I can certainly think of worse things to own. If you want some exposure to something that's not AI, well, you can probably find that somewhere else too, to be honest, Steve.
And Steve, it's PwC again. I've just looked at who did the audit for WHSmith. So in the last year, I think, so PwC have been fined in Australia where they've taken government information and used it for commercial gain, essentially taking confidential government information, and they used it to advise clients. That's controversy number one. They were obviously wrapped up in the Evergrande scandal in China. They've been banned from operating in China for 6 months. In August, they failed to report fraud that they found in the London Capital and Finance accounts. They got fined 15 million squids. They got fined for an audit failure in their audit of Wyland's bank. They got fined for Babcock in 2023. Obviously, they were the auditors that missed the fact that there was half a billion quid from the Wirecard accounts. They are a shocking auditor. They're a big auditor. Let's not get this wrong, but they're very, very bad at their role. They ended up the review of these accounts ended up being done by Deloitte, who found the issue and reported on the issue and put a scathing report out. And this is just blunder after blunder for PwC. So look, I think when you get that question on our risk thing that says, do I know these numbers to be absolutely true and and without fault, you just have to look who the auditor is, and if it's PwC, it's almost guaranteed because you can put anything you want in there and they'll sign it off, Steve. So that's a little bit of a worry, but I sort of agree with you, Steve. I think there's probably better things to be looking at with WHSmith at the moment, but that doesn't mean that this isn't a company that shouldn't. Perhaps when this is behind them, you shouldn't have a look at and see how you feel about it when the controversies are definitely out of the way, Steve.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.